Good morning or good afternoon, depending on what side of the country you're joining us from. Thank you for joining us today for our 2025 industry update for planning and budgeting. It's hard to believe that it's already budgeting time of the year, but we are there, which is just unbelievable. The year is cooking by quickly. Well, I'm really excited today. Charlie McQueen, President of McQueen Financial. I'm thrilled to have three incredible guests with me today to talk about all the wonderful things we have to do. Joining me today at first is Craig Cecilia, our Chief Investment Officer and Managing Director. Craig, thank you for joining us.
Yeah, you're welcome. Glad to be a part of today's webinar.
And then Heather Shepperly joining us. Heather's responsible for all of the asset liability management and CECL activities, technically VP and ALM Director. Heather, thank you for being here.
Thanks for having me. Looking forward to it.
I am too, especially with some of the neat data that you've pulled together. It's going to be fun to look at some of the pooled data that you've put together for us. So thank you. And last but not least, Dan Martin, Senior Consultant. Dan heads up our valuation area of the business and merger valuations and MSRs. Dan, thank you for joining us, your perspective on the transaction side of things.
Yeah, thank you. Should be a good conversation.
Yeah, I'm looking forward to it. All right, as usual, if you have any questions, please feel free to click on the Q&A button on your screen, and we'll go through and answer the questions along the way or at the end, whatever is most appropriate at the time. And if you'd like a copy of the webinar, please reach out to your advisor, and they'll be happy to send it to you and share the information with you. Also, it'll be on our YouTube channel and also on our website. So without further ado, we're going to hop right in. A couple things today. We're going to start off with a brief conversation on inflation, and the Fed's pivot activities are very important for setting rates and plan for the remainder of the year. We're going to quickly hop over to asset liability management, specifically including CECL, then get into our investment discussion, then mergers and transactions, and then a few projections and closing comments by the group. So with that, Craig, an interesting chart here, and the whole team actually, scarcity value, something to start off with. Every day, every institution, bank, credit union on this webinar is more and more valuable. We continue to see the number of banks and credit unions consolidate, and so every day you're more and more important, so please don't forget that. But one of the things when using ChatGPT and other softwares, make sure you ask the question correctly. I asked ChatGPT to graph the number of banks and credit unions in Michigan over 10 years, and this is what it provided to me. Well, I know the numbers are wrong at the end from just knowing the industry, so then I asked Google AI the number of credit unions and banks domiciled in Michigan, and I got a correct number. Both graphs are correct, but just be careful on how you ask things with ChatGPT. Just kind of a fun thing to do when working with AI. With that, great joke here off the side, but the K-shaped economy, which is not a joke. And this is one of the things as we have our economic discussion to remember. Some people in this world are in a really good spot. If you've had a house for more than 5 years, you have a 3% type mortgage, things feel really good. Comparatively to someone who doesn't have a mortgage, is renting and has been renting for the past 5 years, they may not feel as good. So it's a really, dichotomy-based economy or a K-shaped economy. Craig, anything you want to add to that?
Yeah, no, it seems like got history repeating itself a little bit, if I'm not mistaken. And it not always is pertaining to haves and have-nots, but how people are running their balance sheet and their income statement, their household. And someone that makes is very wealthy in a high tax bracket could still have not, really, if they don't really save and structure their revenues and their expenses appropriately. So it's very true. We do have this splitting economy based on fiscal management of household budgets.
Yep, definitely some differences there. And so some people may feel very differently with some of our comments than others. And just got to remember that K-shaped component today.
Yeah, right on.
Well, the Fed made a big pivot, Craig. We've seen 3 pivots since 2005 when the Fed changes their direction substantially, and therefore rates are going to drop like a rock, correct? That's what happens next?
It's like putting a pebble into the ocean. Where does it go? Right down, rates going down. That's what the whole market's expecting. And what's really interesting, though, we do have a pivot, and it's the right thing to be doing. We have a soft landing happening, but not necessarily our rates going the same way that everybody thinks they are. One of the comments that I don't think we have the curve right now for where it was prior to the Fed dropping rates 50 basis points, but the 10-year is actually higher quite a bit than when the Fed, right before the Fed dropped rates, as well as the 2-year, something like the 2-year's up approximately 36 to 40, and the 10 years up somewhere just shy of 60 basis points. So they're lowering rates, but we have a reshape of the yield curve, which is looking beautiful. And we expect that to continue on as we kind of go through today's presentation.
Yeah, definitely interesting. So we're going to continue forward here, and we've got a great question we're going to talk about on some MSR valuations in a second. So we'll get back to that question here. But when you, got to go back a slide. I apologize.
I love early questions, by the way. Thank you.
Yeah,
Whoever put that out there.
Well, maybe Dan, you could answer this since I happened to hit the wrong button. It's going to take me a second to recover from my mistake. The question, Dan, was about MSR values. Do we expect to see MSR values holding up in 2025, declining? Where do you see MSR values?
Yeah, so really as we get a slight increase in prepays, that's going to lower the value of our MSR assets. I don't see it being a material change this year, but we should see a little bit lower value there compared to, kind of the historically high values we've had over the last couple of years.
Cool. Thank you very much, Dan. I appreciate that answer. Well, jumping back here, Craig, normal outcome from a pivot, lower interest rates, and usually something's broken in the economy. I can't quite figure out what that is yet. Can you?
No, not quite yet. There are some signs, like there's never a unicorn economy, even though we like to say there is such a thing, or a Goldilocks economy. We have some issues out there, right? And I think we have some slides on some delinquencies, right, later on, right? So
Yes.
there are some little speed bumps, if you will, that we're seeing. But in general, we have positive GDP. We still have full employment, even though it's been rising. I don't see a ton of things broke right now.
Yeah, definitely interesting. We will see, and Heather's going to talk a bit about deposit to growth and loan demand decline coming up here, and some potential loan losses. We talk about CECL, but those are the normal outcomes that are going to take place when you get into this economic type environment. Although we do have a lot of weird things in this world. I know since we originally put this together, just the last day, the Boeing strike is out at least a vote at this point. Some hurricanes hit Florida, causing a lot of damage. The port strike is not done yet. Everyone says, "Hey, you're wrong with this slide," but they agreed to a labor cost increase, but they punted until January 1 on automation, and shockingly after the elections, right? So trying to move stuff back a little bit. There's a lot of uncertainty with Israel and Iran. We've got Russia and the Ukraine continuing, multiple wars taking place. And we're not hearing a lot about this, but more and more of the violence in Mexico with the new president coming in and some of the problems they're having there. So definitely a lot of things. And I know, Craig, one of your favorite people at the bottom here, Jamie Dimon, had a great quote a couple of days ago. Geopolitical risks are surging, conditions are treacherous and getting worse. So this means a soft landing, right?
It does mean a soft landing. Just remember, one event doesn't define an economy or whatnot. And then, Boeing, God bless them, they've been struggling, right, with between the Boeing breaks, and Boeing strikes. It's not too early for that, I don't think. But there's just a lot of different unique things that are going on that add to a normal cyclical environment for any economy.
Yeah, definitely an interesting spot here with all that. Well, the Fed did lower rates, and we've talked a bit about this. We're going to look at inflation, but less concern on inflation, more focus on unemployment. I think that's an important thing to remember. That was part of the shift, and they're looking at what's happening. So I'm intriguing to see where things go. With that, let's look at the inflation rate. Craig, it's declining, so it's a good thing, right?
Yeah, it's declining, and it's declining at a decelerating rate as well. Inflation is present. We all know that. And just as a reminder, we don't expect prices to deflate, right? Just we do want some inflation in our economy. It's good for the health of every economy. And it's getting back to normal. It really is. And looking at both measures of the CPI as well as a PCE, both of them are looking good for us.
Yeah, they're looking in the right direction. A couple questions had come in on looking at budget deficits and deficits in general. Both of them refer to. One of them talks about the deficit compared to GDP. We had a conversation about an hour ago on this in the office, just that anyone on the call here was privy to. But this is a concern that we have, is the amount of spending. And we look at it doesn't matter which party's running for election at this moment; they both are running on a platform of spending money, which is a bit frustrating. Craig, do you feel this has become a bigger problem or a big problem in the next couple of years?
From a debt standpoint, I think that's becoming a problem, not just for the US government, right? Because when we surpass the amount of GDP with the debt number, a lot of people have that theory that there's no coming back. Well, we did come back, but it was many decades ago when this actually happened. But I also want to just not throw a rock at a glass house, whether you're talking about corporations or households or municipalities or the US government. You chart that debt graph, it's looking pretty ugly. I get a good workout trying to climb those hills.
I do think I love that. I'm laughing through that one. That was good. A good workout. I do think this is something that's going to become a bigger and bigger problem. Our capacity to service debt is going to become an issue. Covering our interest payments has become the biggest expenditure. So yes, it's going to be a problem. I rank it as a pretty high problem. Hopefully, though, we can continue to grow the economy and curtail spending. That'd be like to see the next thing happening, and maybe Elon Musk comes in and becomes the efficiency officer and cuts all the expenses. So we'll let that one die and move on to the next page here.
How about Jamie and Elon together working on running the government?
That'd be great. Two of the smartest people in the world. We are seeing, though, some tough inflation numbers. Auto insurance, which is something that bothers me, and homeowners insurance is also very high, not on this list, where I worry about the money that we've lent people on, that we have to make sure they have enough money to pay for those higher insurance capacities. Rent is still too high. Housing is still too high. A lot of things are high, and the hard part is, though, the things that mostly saving on, the very bottom is used vehicles, rental cars, furniture, appliances. Those are falling, but those are not everyday purchases. Now, gasoline has been one of the best things, and making sure that we continue to drill in the United States has been one of the biggest things, as we are the largest producer of oil right now. So definitely some positives there. With that, though, to hit unemployment quickly, Craig, we continue to see unemployment going up here, not skyrocketing, but maybe normalizing is the word you'd like to use.
Yeah, I love that, and it's a great debate, and I'd love to hear some questions from the audience about this as well. Is where is the unemployment rate considered normal, right? As our population grows and economy grows, the whole big range of 4 to 6%. I do like a target of 5%. We're below that, but you really look at that acceleration of increase, from where we were to where we're at now. It did soften this last minute, but that was what really was one of the catalysts for the Fed to lower rates.
And here too, jobs opening, JOLTS, my favorite, Jolt Cola, it's down. And so we're seeing the number of job openings down, which should continue to put pressure on the unemployment rate upwards. So this is one of the big things the Fed was keeping a close eye on. So really appreciate that. And home sales, definitely seeing things slow. We're actually at the same level of home sales that we were after the Great Recession in 2008 and 9, matching that, which means there's not a lot of supply.
Right. Yep. And there's still demand there, even with these higher rates, even though we have a lower production. So we do need to have more homes to help fix some of this real estate market value escalation.
Yeah, there's a trade up. If you go from 0 kids to 2 kids, all of a sudden you need a bigger house. And so those things are happening. But the hard part here is record high prices. And there's some positives and negatives to this.
Yeah, huge amount of wealth creation there, right? For places. The problems, though, as you probably know, is if it's hard to flip out of a house, even though you want to monetize some appreciation. But where do you go into? It's very expensive to rent and very expensive to buy, but also you have a tax reset, and that would be a huge change for a lot of people. I've heard of people wanting to downsize into condos, but it's too expensive for them to actually get out of a appreciated house into a condo because of fees and taxes.
Yeah,
But
Big issue with that, yeah, and the fees and side of things with that. But as record wealth has come in, and we think about stock prices too, or record high stock prices, which we run into record high stock prices every year, basically. But the two combined has really created a lot of wealth out there, which is very interesting when thinking about maybe a struggling economy, and then we pop up with large wealth.
Yeah. It's one of the things that really offsets some of those negatives that we saw, some challenges in the economies, those 10 events that are going on and what's happening. And but that wealth effect that we've been experiencing has really helped us enter that soft landing and be a part of a good economic cycle.
Yep, so definitely good points there. I do think as we transition over to our next section, a lot of uncertainty out there today. There's a lot of debt as brought up, and I love those questions. And also there's a lot of wealth. So one of the things COVID did with the COVID cash is it's made a lot of economic predictions very, very difficult from where we've been historically. So with that, we'll hop over. Heather, let's chat a bit about asset liability management and CECL. You've got some incredible graphs here. Thank you.
Yeah, thanks, Charlie. So definitely some interesting trends we've been seeing and some things to take into consideration, especially as we're looking at budgets, looking at planning for next year. A few items that we really want to kind of point out and monitor and watch is our cost, is our losses that we may see start to pick up. You can see in this top section, when we look at our ratios, loans to deposits have been fairly stable. It's kind of gone up and down a little bit, but hand in hand goes our losses. When we monitor and watch CECL, you can see from a year ago, we're around 45 basis points. That's gone up 16 basis points in this last year. Increases are expected to happen. And the takeaway here is making sure we understand that, yes, we have seen losses increase over time, but we're also still getting back to normalized levels. So we need to make sure that we're preparing appropriately and watching what these trends may be looking like. This is also causing some of this impact of this margin squeeze we're expecting to experience here in the next year or so. And you can already see it in our ROA as that's come down about 9 basis points over this last year. Some of that is having to do with some of the pickup of losses, and then also some of the pickup of our expenses. So when we go down to the next section, looking at our margin and spread, we've been able to take advantage on the asset side of the balance sheet. We've got some nice slow increases in our loan yields and our investment yields, but unfortunately, that's been outpaced by our increase of expenses. So if we go down to our term deposits and cost of funds, this has gone up fairly materially. This is going to cause some of that squeeze that we're expecting to see and something to prepare for. So there's some opportunities that we have with this as well, compared to what we were experiencing in the last couple of years. So if we go on to the next page, we can see some of these movements that are occurring that we can start to mitigate or take advantage of. So some interesting volume changes that have happened through the pandemic. Loans have been kind of up and down depending on the year and depending on what that demand has been. But looking at where we've been over the last year, this has definitely contracted a bit, but there's still opportunity there. And we're going to talk a little bit more about some of those different types of products that we can kind of hone in on. Now, when it comes to deposits, we did see a very large increase because of the stimulus that came in as we all expected, but then we saw a big runoff happen as well. And the trend that we want to monitor and really see here is how that reduction of those non-maturities has slowed significantly. We were concerned in 23, but that has really slowed down. So we're not as concerned with some of those deposits, but the major focus is the term deposit and borrowing side. You see how materially that has increased, and which has caused that cost of funds to go up as fast as it has. So the benefit of this is many of those term deposits were fairly short term. So as those are coming due, this is where we want to take advantage of what the market's given us. We've seen the Fed drop rates 50 basis points. And with that retraction that's happening a little bit, let's really focus on that term deposit and borrowing side to really try to bring those costs down to offset what we may be seeing some contractions on that asset side of the balance sheet, especially with the pickup of losses that have been going on.
Heather, I really love this chart. A couple things here. It really shows what happened when we had the COVID dollars come in and look at the loan dip in 2021. And we're seeing a bit of that now in 2024 and into 2025. One of the things we're going to talk about is potential for lower loans. So it'll be interesting when we get there. But I think that's neat. A couple things came in, just real quick questions. This based off of our financial institutions or nationwide. This is actually clients of ours, and it is nationwide. There's a client from every state at minimum in the country. So really, really good data here. And we're going to see some more national data in a second. So really appreciate that. And we'll keep going, Heather, to the next slide.
Yes. And this is just another kind of view from a nation standpoint. I love that question because we really do want to see what's happening in our industry versus as a country. So the FDIC is showing really that same pattern that we just saw in that previous slide, where deposits did rise, but they came back down, but they're level setting a bit right now. So that is definitely something. I'm sorry, for the loan growth, we were seeing a nice stable opportunities here, but we're going to want to really watch certain different asset classes as we get into that and some of the losses that are attributed to those. So we'll see that here in a moment.
Yeah, and I appreciate that, Heather, because one of the things I worry about is people really trying to get loans to the books this next year that are not good loans. So
Right.
really sticking to your standards is important. And Heather's going to highlight that here, but a quick chart on loan yields for you.
Yeah, so some nice growth and nice increases when we're looking at this overall for the industry for loans. And we're splitting this between over and under $1 billion. And no matter the size of the balance sheet, everybody is doing a great job really taking advantage of what that increase in yield has been. So we really want to hold on to that as long as we can, especially as we're seeing things start to contract a little bit.
And definitely unique that we've got those yields converging like they are here right now. Typically, we'll see the larger banks at much higher yields, and but it's looking good. Now here, going back to your deposit statement earlier.
Yes, yes. So one area that we did see examiners being concerned about, as you saw that trend of how fast some of those deposits did leave in 22 and 23, is this almost bell curve. But as you can see, as deposits shot up with the stimulus, look at where we are now. We have not come back down to those pre-pandemic levels. So we do still have a decent amount of deposits to be able to have on the balance sheet. Now, with that, we are seeing some of that run off as we saw that influx occur that did dilute our capital a bit. So with this happening, this gives us some flexibility of allowing that balance sheet to contract a little bit. And we're going to see some of those examples of some of the things that we can do here as we start to look at the other moving parts. So again, our cost of funds is an ongoing concern and major focus point as those deposit needs for liquidity standpoint really cause those expenses to rise. And you can see how fast that increase, especially in 22, 23, we're starting to see that level set a little bit, and we're hoping to be able to bring that back in as we get into this next year and contract these a little bit. The cost of funds is definitely an area of concern.
And I do think this shows some of the really large institutions in the country are quick to raise their cost of funds because they have a lot of floating rate loans to offset it with. So it's actually interesting from an asset size difference here, but absolutely what we're seeing today. Now this one's a fun one. Basically, this says nothing, but one of the things Heather and I were talking about earlier today, we are seeing a lot of mortgage companies doing cash out refinances right now, which scare the daylights out of me. I think we really need to focus on financial education for all of our customers and members of our institutions on the call. No one should be getting rid of a 3% mortgage and refinancing an entire house into a 6.5% or 7% mortgage. But that's what we're seeing right now. Really, really crazy, Heather. It's nuts to me.
It is. And I think there's different opportunities we can take when it comes to the retail side or the real estate side of things. Refinancing of mortgages, I don't necessarily think that's the right way to go right now, just as Charlie had stated, with that significant difference in current market versus what was booked prior to that increase.
This is a neat chart here, Heather. I love it. What this does show is credit card debt is still growing, but growing at a slower pace, right?
Yeah, it's we saw a big peak up as everything got significantly more expensive, but that is definitely slowed, which is good for us.
It's still growing out there, just to make everyone understand that credit card debt's still growing. But loan growth, one of the things we're going to talk about here, our predictions, is lower loan growth than what many people are ready for. -5 to +5% is going to be the range we're going to be in. And total loans only grew 3.4% for a year ago, the smallest 12-month gain since August 2014. So really amazing how much the loan growth has slowed everywhere. So it's going to be interesting to watch with the ALM and CECL side of the world, Heather.
Yeah, and we even saw it on a previous slide, and we're only seeing single digits of loan growth. So there is opportunity there, but not nearly as much as what we've experienced historically. So we got to play that game appropriately and balance the balance sheet to be able to handle that.
A quick question that came in is a great one, asking about is the revolving credit card market losing market share to buy now, pay later, like Karma, Klarna. There's a bunch of them out there. Unfortunately, a lot of those companies do not release their data. It's supposed to be put in credit reports, but a lot of clients keep telling us they're not seeing it in credit reports yet. So we do think that the debt level is much higher when you bring in those credit companies, the buy now, pay later stuff. So that will be interesting over the next couple of years. So Heather, let's get into CECL a little bit.
Yeah. All right. So when we look at CECL, this is a little bit different than what we had to do historically of planning only for a year's worth of losses. We're now planning for the life of the loan and the losses over that time period. So one of the first trends we wanted to look at is we know losses are starting to pick up. They're not quite to that normalized level that we may have seen historically, but where are the areas of the focus? And I found this really interesting as you're looking at the top section of lines of credit, credit cards, standard, revolvers, you can see there's a significant increase of losses that have happened from 21 to 24. We're looking at 6%. These are the areas that we want to really hone in and focus on the most in regards to concerns when it comes to losses. These signature type of loans are very high. The next section, looking at autos, the difference between direct and indirect. We need to make sure that we are being very diligent on our underwriting, especially when we're working with dealerships. We want to make sure we've got a good balance here. There's a significant higher loss ratio when we deal with those indirects versus that direct lending. So something to keep in mind with your relationships. When it comes to the commercial side, we're not seeing much loss activity, which has been fantastic. And the same on the mortgage side. This was one of those pieces we were looking at from the refinance standpoint. I think we have more opportunities when it comes to the equity side of things. We're not going to see the losses, as many consumers are not going to walk away from a 3% mortgage on their home. They're going to pay those loans. So we're not seeing any really large losses in regards to this real estate market, but I really think we got some great opportunities in equities instead of refinancing to take advantage of that extra equity that's in the homes that are already locked in at those hyper low interest rates.
I mean, more recoveries than write-offs. Pretty crazy here. And
Right.
but we'll wrap up a few things here. Some CECL factors, Heather.
Yes. So when we look at our factors, this is that forward projection for where those losses are going to be. This is something we need to prepare for. This is going to be the part that is going to continue to cause some pressure and squeeze to margin, is that expense of future losses. So just really monitoring and watching the types of products that are higher. Look at your CECL, make sure we're planning appropriately and that you're lending appropriately. We're okay allowing that balance sheet to kind of retract a little bit as we let some of that lending go away if we're not comfortable with the possibility of the losses that go hand in hand with it. And then some of the deposit activity that's happening as well. We really want to make sure that if we have an opportunity to allow that balance sheet to contract a little bit, it's actually going to help our equity position, as it's going to shrink a little bit more and monitor that nice income that we really can take advantage of, really bringing up some of those capital positions that took a little bit of a hit during that influx of cash from the stimulus.
Yeah, great data there. Really interesting to see. So with that, Heather, all the things we're seeing here, earnings at risk, how are we looking there? Are things getting a little worse or a little better?
So our earnings from a risk standpoint seem to be fairly stabilized. We're not necessarily as concerned. Now, as we look at the down scenario as rates come down, this is where that flooring of non-maturity deposit rates may hurt us a bit as we can't reduce our expense. But this is where we want to take advantage of a pricing of our term deposits. This is where we can bring some of those expenses down and offset some of that that is starting to hurt us a little bit in the down risk position. But all in all, is we allow that to contract a little bit, price our deposits appropriately, and allow that equity position to come up a little bit should really stabilize us to be able to handle what's to come.
Yeah, and we're going to talk about OTTI and other things with Dan's presentation in a minute, but it definitely is improving the equity position for a lot of people. So with that, Heather, thank you very much. Really appreciate your insight and information. Great thought there. A lot of things changing with ALM and CECL. I know it's keeping everyone in your team super busy right now and really appreciate it. We've got a couple questions in CECL that came in, which we'll address at the end at this point. So thank you for those questions. Keep them coming in. Craig, what's going on in the investment world?
Oh, there's lots of great stuff happening in the investment world, that's for certain. We always like to start off our economic presentations with our clients, whether the ALM or investment advisory clients, with a good old yield curve, right? Kind of paves a path of strategy and conversation as we look at today's chart graph, that red dashed line, that's today. You can start to see what I mentioned earlier is a beautiful yield curve, meaning it's a positive slope and it's going to continue that way. We do expect it to continue to get a little bit more steep. And ultimately, what the yield curve is telling us is that we're not actually going to see a recession type environment, right? It's not inverted anymore. We're getting past that. We're recovery. And I used those terms earlier, soft landing, and we are doing a soft landing. It's the second time, I would have to say. Arguably, some people say it's the first time, right? When you go back into the
Could be
90s.
95.
It could
Yeah,
be,
could be.
yeah.
Second time.
But ultimately, it's telling us things are not as terrible as the naysayers say it is, and things are looking good, and it's good for planning, for budgeting, and investing.
Wasn't that 95 when Charlie and the Chocolate Factory came out, and then we just redid it again? So the Oompa Loompas visit twice for soft landings. Is that how this works?
I'd have to refresh my memory banks on that.
All right, I'll check. I'll do some Googling here, but
Yeah, thank you.
pretty
So,
crazy graph here, by the way.
yeah, the 10-year yields here, you can see the volatility as it has been coming down. And you look there at I like to really look at not only the long-term trend of the Treasury, but also look at the short term and see what's been happening. You can see it's been actually coming down for since April-ish, March, first quarter since, and all of a sudden it's picking back up, even though the Feds are lowering rates. And we're seeing this as good opportunities in the investment world as we see some value out there, and then strategies that can be implemented when investing and managing your balance sheet through use of your investment portfolio.
With the managing investment portfolio, you've got a lot of options of things to buy out there besides the 10-year Treasury we threw out there. Talk to me a little bit about some of the value differences here in diversification.
Yeah, absolutely. And we have up here 5 different asset classes. They're the most typical for our audience today. We know there's several others out there that we're not going to be discussing today that may or may not be appropriate to best, depending on risk appetite, and tax status, and whatnot. But as we follow through look at this chart, we have the riskless curve there. Riskless curve, somebody's going to have to help me out with colors because I am terrible at color.
Well, it looks purple on my screen. It's on the bottom. That'd be BQ Muni. So it's blue in the middle is
Okay.
Treasury. I'll put a little note on it
Perfect.
for you.
Thank you. So treasuries and the blue is the riskless curve, basically what everything's priced off of. And you can see that curve. Now, if you go there, the BQ munis, we're not going to spend a lot of time on there. It's lower. It needs to be taxed up because that's the pre-tax yields. But as you shift up from the riskless curve, you're getting to agencies, bullet agency yields, no optionality, no negative convexity. Then we get up to what is the taxable muni curve. And then the highest, the green, is at the corporate curve. And one of the things that people are looking at when managing their investment portfolios is, of course, following some principles we'll talk about later, but ultimately it boils down to they get to yield. What's the best value that I'm going to find on here? And if you look at just what is the best yield, you can look at this chart. But then you're thinking about value. Value investing also needs to bring in, my opinion, some risk. And even though, say, corporates are up there, they're not necessarily the most value there because we're not getting that risk-adjusted return. So I just want to keep that in mind. And here's a good example here is we have the credit default swap. And this is for investment grade. And the volatility of this chart, as the chart goes lower, the markets are making financial bets of that's the lower probability that the corporate market's going to be defaulting. So the credit default swaps, those are really low right now. If you look back historically to the left, it's when's it been this low, right?
Well,
It's
yeah, because basically what you're saying is a time where people are calling for a recession and a bad economic environment, the Fed lowering rates. you're calling for a soft landing. I get that, but others are calling for a recession.
Mhm.
And we have credit default swaps at a record low level. So meaning the risk out there is perceived to be extremely low to corporations.
Right. So there is a major disconnect between this and some of the how some people look at how the economy is going. If you go to the next slide there, we also have is the spreads, and we're not going to spend a lot of time on the slide, but it is for a single A, double A, average corporate spread. And again, we're near lows since the Great Recession on spreads. And so it goes back to, even though it may be the highest yield, if you look at it from an asset class standpoint, are we truly getting compensated? Here's the nugget. Are we truly getting compensated for the credit risk that one would be putting into their portfolio, into their investments? Would they rather take it on the corporate lending side, get compensated for that risk, and then shift over to, say, the municipal side where you're getting compensated historically from a spread standpoint as well?
Yeah, so another way of saying this, it's been since 2005 that spreads have been this narrow, that you're getting this least amount of additional compensation for taking on corporate credit risk.
Right on, right
Yeah.
on.
Okay.
Absolutely.
All right. Well, just to add, 2005 is when Charlie and the Chocolate Factory first came out. So now we have three things. Spreads are at the lowest since 2005. Soft landing, Charlie and the Chocolate. I mean, I think this is the trifecta.
Absolutely. Wasn't there something with the Red Wings going on back then too, or something of that nature? I don't know.
All right. Someone's got to
Heather would
Google.
know. I know
Yeah.
that.
Heather's going to start Googling that right now. Thank you, Heather.
2002. So I'm close, right?
Yep.
All right. So also wanted to add in, just kind of, so as this meeting is kind of themed as strategies, some being used, some to think about going in through this cycle in 2025, is never forget, safety, liquidity, yield. It's the bellwether of strategies, the SLY principle. And a lot of clients, as well as the market, uses various ones. And I just wanted to cover a few of them that are very common right now. And one is the traditional ladder. As we layer in liquidity, we've seen lending slow down a little bit. Liquidity has been stabilized. And with that happening, we have liquidity rolling off and just reinvesting into the market and laddering your portfolio. One, keeping a good ladder. Two, provides a good ample amount of liquidity over a period of time and term. And then looking at providing stuff when you need it. So the other strategy is looking at the duration, right? Which we're getting down to the fundamentals. Heather did a great job covering the interest rate risk section, some analytics and stuff. And with the portfolio, one of the things that we're doing with our clients is we're utilize that as a tool to manage the balance sheet and interest rate risk. It's the asset class you can make 100% of that decision on what happens with your risk based on what you do with the portfolio. Well, again, if you get into some negative convexity stuff, you might lose some of that control. We'll talk about that in a moment. But duration right now, people are utilizing the portfolio to offset a little bit of increasing interest rate risk. As Heather said, we saw yields stabilize and cost of funds. They skyrocketed. They really went up. Asset yields didn't keep up with them. But now we're expecting yields to be coming down, both on earnings on the asset side as liabilities. Well, we know liabilities can't fall as much, right, as asset yields. So we're going to see that increase in NII sensitivity, and you can use your portfolio locking in that right duration for yields and offsetting some of that upcoming interest rate risk. The other thing that we mentioned, we'll skip over corporate spreads, not always the best value, even though it's the highest yield. You got to be careful. You got to bring in credit component, make sure you're pulling down 10 Qs, run your credit reports every quarter on your investments that you have in corporate space. If you're not, find somebody like us that can do that for you. And then the other thing is building cash flows. One thing that the regulators, the feds, is super worried about is cash flows. Having enough liquidity, having enough pledgeable securities to accommodate for those increased lines that you have that require them. And then the last thing here is, filling in the donut hole. I think somebody would love to hear that, right? Is, people went in through this cycle with high cash yields using a barbell strategy. And now as rates are coming down, they're filling in that hole where the barbell was, putting their assets to yield, making sure they're not reducing it to zero cash, but they're reducing their cash positions, locking in some yields there. So a lot of great strategies. Depends on what's right for you, but those are the ones that are most common being used in the market right now. We think some are great. Very good thoughts to remember. And closing here is stay away from negative convexity. It's not the best thing for most people. Now, I said most, right? There is sometimes a time and place you can work with mortgages or well-structured CMOs to protect you, but don't buy calls out there. You lose control. You can't manage your interest rate risk when you have a bond that's callable in 3 months and continuously callable. It just doesn't work unless you have a balance sheet that can really offset that. Um, Use duration to your favor right now. Interest rates are coming down. I do expect a re-steepening of the yield curve, so don't get too crazy, but use it to your advantage right now with some of the yields that are coming down. And then also stay with cash flows.
Yeah,
Okay.
really, really important there, Craig. And even you start to get some deep discounted activities, it doesn't make sense, because what I worry about is what happens when all of a sudden everything in your portfolio loans start to refinance. Everything refinances. You really want to protect yourself in that downward rate environment.
Yeah.
Well, there's been a lot of wealth creation out there, not only for individuals, but for foundations. You're doing a lot of work with foundations these days and managing that money. That's been a really good growth area for the foundations, right?
Absolutely. So we did introduce McQueen Charitable Solutions, working with foundations, endowments, Taft-Hartleys, and just like what you mentioned earlier is that wealth creation on household balance sheets, and it's been growing in them as well. We were doing a fabulous job, and it's just a great opportunity to be making sure they're using the right strategies for managing. A lot of our clients on today's call are on boards and are trustees. And if they need a sounding voice or somebody to help advise, we're there for them. The other thing that's interesting is the bank holding company. We have clients that have holding companies that can invest in a lot more than the bank. Those portfolios are doing very well also. So, and then our employee benefits and then the charitable donation accounts continue to perform well and benefit from this economy that we're having.
Yeah, really, really important there. And IAM is doing really well also. So thank you, Craig. Really
Yep,
appreciate that
you're welcome.
update. And great things happening out there. Great wealth generation has been wonderful in earnings for our clients. With that, Dan, let's talk a bit about mergers and transactions and what we expect to see this next year.
Yeah, thanks, Charlie. I think the first thing to look at when thinking about trends for next year is really look at what's taken place this past year. And so, starting kind of on the credit union bank purchase side of things, we've seen a huge uptick in transactions. It's a record year. This is really a pretty good looking graph, kind of straight up to the right there. I think this is something we can expect to continue to see moving forward. 2023 was a little bit of a down year with the whole SVB debacle. But it's something that, is going to continue to happen probably at an increasing rate. So if you're in a position to take advantage of this kind of unique market opportunity and have the adequate capital, it's certainly something you should take a look at. Now, if we flip to the next slide, this kind of just shows concentration. So when you think about, entering a transaction like this or considering this as part of your strategy, there is some geographic nature to this. So we can see, kind of the Southeast, Midwest, and then now the state of Washington has had a number of deals in the past year are really kind of the core concentration. Certainly, there are some states that are relatively restrictive in this activity, Mississippi being an example, Tennessee being another example. But for the most part, there's a ton of activity in these three regions of the country. I think Texas and California are probably next in line. So, we could see some more new geographic regions unlocked this next year.
Hey, Dan, do you have concerns over legality of creating and acquiring banks, or is that not a nationwide problem?
It's kind of more of a state by state basis. I don't see any states really stepping up and saying, ahead of the game and saying we're going to disallow this activity. It makes a lot of sense from really all parties involved. So I don't see a ton of regulatory risk outside of states that have already, issued opinions and have disallowed the activity.
Okay, thank you very much. Appreciate that answer.
So I think one thing to look at that I just find interesting is just kind of general market trends in this space is we've just seen a ton of larger transactions. So as this becomes a more popular activity for larger institutions, I think we've seen the size and scale of these deals, increase. Global FCU, that's a deal we helped them with. First Financial Northwest, $1.5 billion. That's the largest to date. And I think this is a trend we'll continue to see as some of these larger credit unions gain in size and scale.
Yeah, definitely continuing to go up market and get bigger and bigger as we go forward. Now, leaving there and heading over to the branch side of things, what are we seeing in the branch world?
Yeah, so, if we look at back since 2018, we're not in any sort of a banner year. We are seeing the most transactions in the past 3 years. I think this is just a function of picking back up on lost demand. This is a really interesting thing that people are continuing to expand on the branches that make sense for their strategy. I think if we flip to the next slide, it kind of depends what your strategy is. So, if we look at some of the larger financial institutions across the US, we've seen a lot of branch closures kind of changing that strategy. So as you go forward into next year, being very clear and deliberate in, what your branching footprint optimally looks like. Does that involve closing branches, or does that go out and acquiring branches make sense? The biggest thing in looking at these purchases is it is a fairly capital restrictive activity. It's typically done as a purchase and assumption, which is dilutive to your capital. Some nice things we've seen really are a couple opportunities to mitigate that is through the use of subordinated debt. We've had a ton of clients go out and get apply for this and get approval. Once you have that approval, you're good for 2 years to go and potentially issue debt at probably about an 8% rate today. That helps kind of cushion your capital position. Recommend most people do that. Even if you're not going to use it, it's nice to have that dry powder in your pocket. The other thing that's kind of a newer thing is sale leaseback. So if you own all your branches, there's some funds out there that are willing to buy your branches, inherently boosting your equity. The downside there is you're locking yourself into a long-term lease at probably 9% today. So, as long as that's factored in your overall strategy and income into the future, that can be a viable option as well.
I definitely think it's interesting. A lot of this is looking at what's the right footprint for the future as that continues to change. I keep telling people my favorite branch is the one in my pocket, my cell phone branch, and definitely a lot of things changing there and ways to grow capital. Just to wrap up a few things here, Dan, I know we've had a lot of changes with OTTI declining substantially. I think that's going to springboard some more transactions. How do you feel on that?
Yeah, I think that was a big restriction in a lot of deals. When you just look at kind of capital levels and pricing expectations of different entities, that was, as that kind of solves itself over time, I think that's going to lead to higher transaction volume next year. Certainly, when you look at kind of the credit union merger landscape, that's a similar issue that really resolves itself over time. So I would expect volume to be up on both those fronts looking into the future.
Yeah. I think as we continue to have the evolution of technology and technology that the customers and members want to use, a lower interest rate environment, which really ties into that OTTI situation and capital. But we are still balancing some of these inflationary things. I know, as Craig mentioned earlier, inflation's down, but people costs are still expensive and non-interest costs are still expensive, which may end up driving a few more transactions. Do you believe that's going to be the case?
Yeah, I think when you look at that, in a lot of these transactions, when you're running two separate institutions, you're going to have a lot more on the non-interest expense side of things that you can cut out and save as a combined institution. So that goes back to the size and scale argument. That's some of the incentive in looking at doing these transactions is cost saving. So I think really looking at that, I don't know that it's going to drive a ton of new volume, but that's certainly a benefit we'll see with all of these.
Well, thank you, Dan. Appreciate the quick update here. But I think in the end, what are your comments here on strategy?
So I think the biggest thing is as we look into next year is if you don't have a strategy, you need to have one. Not having one outlined, not having defined goals is inherently a strategy, whether you want to call it that or not. So, there's lots of things you can do in advance of going down the path of looking at a merger or looking at an acquisition. You talk about improving profitability, using EBPA or CDA portfolios as part of the merger search process, getting approval for secondary capital. A lot of things you can do ahead of time to prepare yourself for this if it fits within your strategic plan.
And in the end, if you don't have a strategy, you don't know where you're going, or a plan. So really important to have that plan and know where you're going. So thank you, Dan. I really appreciate that. And now we're going to have a little bit of free for all here with all four of us arguing through a few things and talking about some projections. But just a reminder, this will be available on our portal. So that'll be out there and it'll be on our website shortly after this presentation. So here we go, guys. Let's hop into our projections. Craig, 50 and 50. Is that what we're seeing here? You're on mute there, my friend.
Thank you. Yes, I was on mute. Right now, expectations are for 50 basis points this year, and the market expects 100 next year. I think it's that we're going to have a continued turn of the worm, and we're only going to be going down about 50 basis points next year.
All right, so definitely coming down 50 this year, 50 next year. Some would argue more next year, like me occasionally, but depends
Right
on
on.
depends on the day, right?
It's data dependent.
Data and daily dependent. So speaking of that, data dependent, here's our official interest rate projections that we have for 2025. We've got actually yesterday, year end, and then the next 4 quarters thereafter. This will be available. All the advisors will have a copy of this to be able to send it to you, and it'll also be on our website here. Craig, anything you want to highlight on this wonderful page of numbers?
Yeah, the one thing is the bottom row. Looking at, or I'm sorry, second from the bottom row, our GDP. We do expect a little bit of a decline and then a energization of it. Typically, historically, first quarter is a weak quarter for our GDP. 90% of them are weak. We do expect that to happen again, but positive, not negative, and then go up. And then also, I want to really point out that whole 10-year. It's a big number. Typically, in commercial lending, you got a 5-year, and mortgages, it's 10-year. And you kind of look at our prediction on that 10-year of we do see it coming back down, even though it's been spiking a little bit, then growing way back up over the next year, hitting a high point by the end of next year. It actually might even go higher than that 430 by the end of 25. Maybe, I think you were saying maybe even a 450 or something of that nature.
I was thinking of 450. It's possible that steepening
No.
yield curve is going to happen, and is it how much up and how much down on the short end will be the interesting thing to watch here.
Right.
So really, really important. It does show rates coming down in a lot of ways, and prime coming down. Well, it's going to hurt some of our commercial lenders out there. So definitely some changes here. But thank you, Craig. I know a lot of effort goes into this interest rate forecast, and I do have to give a shout out to you and the investment team. Where we projected to be at year end is effectively almost exactly where we are today. It was one of your best projection years over the last number of years. You always do well, but it was a really, really good projection last year.
Thank you. We appreciate that.
All right. All right. Well, we're going to make a little move here over to point number 3. And Heather, what do you see here? I kind of said I feel bad that I've said -5 to +5. It's a big spread, but it really depends on the type of institution you are, I think.
Absolutely. And depends on where those lending opportunities are. As we saw some of the, unsecured or signature type products with the loss ratios that go hand in hand with that, we may want to retract a bit. So just where those opportunities stand, I do think we have tons of great chances with the equity side of things from a real estate standpoint. Commercial seems to continue to be strong, and just monitor and watch where you are on the auto side in regards to losses and possibly indirects. But the loss delinquency is starting to pick up, but it is going back to normalized levels. So we still have some good spreads that we can make here.
Yeah, definitely some good spreads. And I think one of the things I want to put down there is I just popped slide forward. I apologize. I do want to make sure if you don't have the loan volume out there, it's okay. It's okay not to take it and go forward and shrink a little bit. I don't want to shrink every day. I'm a big believer of grow or die, but we've got to be cautious given the credit environment we're entering. Definitely a lot of activity in the home equity area that can happen, and cash out refinances. I hate to say that. Let's say second mortgage and not pay out the first mortgage, but some opportunities there. But it's going to be a tougher year for lending, and we're already seeing that in this third to fourth quarter data.
Yeah, we saw that from 23 to 24, where that was in double-digit growth, and that came down into the low single digits. So it is going to be a little tough this coming year, but there's definitely some opportunities.
All right, well, flipping over there, Craig, and Heather too, both you can add here, but investment projections, we're seeing investment balances. We're expecting them to grow anywhere from 5 to 15 or 20% this next year as loans potentially stay unchanged or decline. And deposits we'll talk about in a minute, but they're a little bit of a idea what we think of deposits if you do the math there.
There is a driver there, what you're going to do with your liquidity. And right now, this is kind of why we do have that range there. We think investment projections will grow based on not necessarily tighter, but not loosening credit underwriting standards, and just the way the cycle of the market's going to be right now. Heather, do you kind of agree with that in the cycle of the balance sheet?
Absolutely. As we're having a harder time on that invest or the loan side, definitely making sure that you're complementing the structure of the balance sheet, utilizing that investment portfolio. There's definitely some great chances there, and I think you're going to see a little bit more cash moving in that direction.
All right, well, off to point 5 here, as I gave a little premises there, we do expect deposits to grow 2 to 8% this next year, in the positive direction up from where we've seen, and hopefully we're going to see more non-maturity growth. We do have the bank term loan fund maturities coming up, so we've got a lot of things there, and I know a lot of people have really relied on CDs and borrowings, Heather, as you pointed out earlier, and hopefully we see a little bit of a retransition back to non-maturity deposits.
Yeah, I think we're just going to see it kind of transition from term to non-maturity. So I don't think we're going to see deposits necessarily leave. We're just going to see them kind of shift around.
Yeah, it's going to be a tough year for deposit generation, but better than this year, I feel. So
Yeah, and I think that shift, Heather, and I agree with you 100%, is it'll also help us on that cost of funds trend to be reversed and continue to come back down a little bit. Yeah.
Absolutely. Definitely offset some of that squeeze.
Yeah.
Mhm.
So with that into point 6, we do expect asset yields to continue to come a little bit higher. Liability costs really start to hopefully peak out or come down. It depends on your structure and where you are. But really, it's going to be tough to make sure we keep doing proper loan yields. You go into the MFA Navigator, you can go into the loan calculation, loan pricing calculation, look at different things, look at some of your competition out there, but make sure we're really working on managing this cost of funds and thinking forward. All right, point 7. Dan, someone asked us about de novo branches, and there aren't a lot of them out there, but if you are opening a new branch, it's tough. It's tough in this market. But that's to give that advice there. What do you see happening with merger volumes?
Yeah, I think we see everything continuing kind of what we saw this year. We're going to see increased volumes on credit to credit union transactions. We're going to see more bank deals, hopefully another record-setting year next year. And really valuations getting much better as we get some benefit from the yield curve. That should help on all the purchase accounting discounts we've seen over the last 15 months.
Yeah, definitely do expect volume again as OTTI continues to come down, and we'll start to see hopefully maybe some positive impact to bank stock valuations, which then we'll see some transactions pop up there. But again, there's less and less institutions every day, so we can't expect things to go through the roof. So thank you, Dan. Looking forward to that, but really making sure you have a plan in place is one of the key things, not just for the valuation space here, but for everything we do, from interest rate risk management to investment portfolio management to overall balance sheet management. It's really important to have all those things. So as we wrap up here, right on schedule in about a minute, I do want to add there's a couple questions that came in. One relates to CECL. Some people feel they've been over reserved for CECL from the inception. I do think I don't know if IELs are going to modify it or not, but as we look forward, I didn't mention this earlier, as the unemployment rate goes up, that's the major driver for CECL. We're most likely going to see CECL reserves come up. And we want to continue to refine and look at CECL over and over again every day, really important. Another question that came in was about are the new Americans working in hospitality and food service industries and the unemployment figures. And best we know, everyone's included in those unemployment numbers. Always an interesting thing, who answers their phone anymore to say they're employed or unemployed, I don't know. The fact that I'm getting texts from Kamala Harris and Donald Trump daily asking for $5, I don't think I'm going to ever answer a text message either the rest of my life. But definitely a lot of strange things out there, but we do think those numbers are fairly accurate. You got to take some of the swings out. With that, we'll wrap stuff up here. Heather, any parting comments?
Just monitor your balance sheet and make sure we're planning for the future. Utilize the information you saw here today, and looking forward to this next year. Should look very nice. Wonderful.
Thank you, Heather. I think some great insight. Dan, any final comments from you?
I would just say make sure you're planning to have a plan.
I absolutely love that. Craig, any parting comments from you?
Very profound. I like that. This is budget season as everybody is running through it. As you're running through budget season, make sure to reach out to your advisor. Talk about what your plan is. Use them as a sounding board. They may come up with some other ideas because they talk to the street. They're talking to clients all over the country, and they'll be very helpful in your whole budgeting and planning process for both, growth, contraction, interest rate risk management, investment portfolio. We're here to help.
Absolutely. Well, I think with that, I think it's a great spot to end here. We're here to help. Please reach out to any of us or your advisors. Happy to chat and make sure everything's good for next year. With that, thank you all. Have a spectacular day. This will be on our website and available through our advisors. Have a wonderful day, everyone.